How's it going, investors? Ari Gutman here with the TipRanks team, and I'm incredibly excited for today's video because there is certainly fear building up in the market as we enter September. And I'm sure if you're new to investing, it may feel pretty gut-wrenching with questions as to whether or not to sell out of certain stocks, hold tight, or double down on some of your investments. Now, while I can't exactly advise you on those next steps, I can certainly share there are in fact opportunities arising, 3 of which we're going to break down today. You see, there's dividend stocks, then there's dividend aristocrats, and then the elites of the elite, dividend kings. They tend to provide more safety and reliability during uncertain times like we're currently experiencing. So without further ado, let's dive right in. As always, we're going to begin with a brief overview of the economic backdrop, providing the context as to why I keep on breaking down value or dividend stocks at this point in time. Now, all of the recent volatility was sparked just after the Federal Reserve Chair, Jerome Powell, drove home his conviction with a rather hawkish tone for fighting inflation. Now, his recent remarks that interest rates will be rising and they're going to remain relatively high until inflation actually starts to come down is what's troubling investors the most. And until we get more data to digest, it's very likely that we're going to be ebbing and flowing when it comes to the stock market. Now, this all begs the question, what stocks should we be looking into at this point in time? Well, those longer-term investments that provide for more safety are certainly taking precedence for many, which leads us to today's video and breaking down 3 dividend kings, meaning they've been paying dividends consecutively for over 50 years and increasing those dividends year over year. Now, with that said, the first stock on our list today is the 7th largest retailer within the United States. This stock is Target. Now, this retailer has certainly been experiencing the ripples of pain induced by inflation, with consumers who are looking to reduce their expenditures on items not necessarily needed, leaving Target with items from clothing to more expensive electronics like TVs sitting on their shelves, which has certainly troubled investors, and we can see those concerns reflected in their stock share price, as the stock is down 30% on the year, where it was once sitting around $228 per share, now trading for $160.78. Nonetheless, Target stands strong with a market capitalization coming in at $74 billion. And while insiders have sold shares over the last few months, it is certainly a positive sign to see smart money, if you will, those hedge funds, pouring millions of dollars into the stock. Now, investors across TipRanks have also been following suit, with more investors building up their positions with Target. As for Target's PE ratio at this point in time, it's coming in at 18.25, which is less than many of its competitors. And not to mention, analysts are forecasting growth. That's coming in from analysts from Goldman Sachs to JP Morgan. Now, of course, Target as a dividend king is rewarding shareholders with a dividend yield that sits at 2.27%. As for our second dividend king, we're talking about Abbvie, which is a biopharmaceutical company that was formed after a spinoff from another industry-leading healthcare company, Abbott Laboratories. Now, the spinoff took place in 2013, and since then, Abbvie has blossomed and flourished, with their market capitalization currently sitting at $239 billion. And just as many of the companies across the indexes have been struggling amidst the market volatility, well, Abbvie has experienced some of those same economic impacts. And of course, their stock is down on the year from $171 per share, trading around $135 per share. That's roughly a 21% change. Their PE ratio is sitting at 19.2. That is on the lower end when compared to their competitors. And while hedge funds have in fact been decreasing their position with this healthcare giant by millions of shares last quarter, analysts are rating Abbvie as a buy, with a target share price coming up to $161.29 per share. Now, those forecasts are coming in from analysts at Morgan Stanley to Bank of America. Now, clicking on Crowd Wisdom, we can actually see that investors across the TipRanks platform have been taking advantage of this buy the dip opportunity, if you will, well within the last 30 days or so. And until the stock makes its comeback, shareholders will certainly be able to collect on their dividend, coming in at 4.07%. And finally, a stock that is down over 50% on the year, Stanley Black & Decker, one of the largest tool manufacturers in the entire world. Now, given the supply chain disruptions on top of sky-high inflation, keeping consumers away from those DIY or general home improvement projects, as well as the entire construction industry that has been, of course, losing its momentum, this stock that was once trading for $193 per share is now trading for $89.02 per share, with a PE ratio coming in at 14.71, which is considerably lower than many of its competitors. However, this industry leader, with a market capitalization coming in at $13.16 billion, is likely here to stay for the foreseeable future, even though hedge funds have been decreasing their position with Stanley Black & Decker over the last quarter. Although, if we go ahead and scroll down, we can in fact see that these hedge funds are building those positions right back up, with insiders following suit as recent as 27 days ago with a buy of over $1.4 million from a director, which leads me to crowd wisdom. We can see that retail investors on TipRanks are also buying more shares of Stanley Black & Decker. As for analyst expectations, they do foresee upside, with the stock share price coming back up to $114.60 per share. And until that rebounds, Stanley Black & Decker will be shelling out that dividend of theirs at a current dividend yield of 3.51%. Now, investors, that is all we have for you today, from Target to Abbvie and Stanley Black & Decker. Please remember that this video was not intended to be stock advice, but merely to show you through the actual platform that we have here at TipRanks to help you make informed, wiser investment decisions. And of course, before making any of those decisions, do all of your due diligence by utilizing all of our tools right here on TipRanks. Now, I'd certainly love to know your thoughts on these dividend kings, so be sure to drop a comment or two down below. And until next time, thank you for tuning in.